November 14th, 2024. Deutsche Bank announced the closure of its precious metals trading desk. Not a reduction in staff, not a temporary suspension. Complete shutdown. 47 traders, analysts, and support staff reassigned or terminated. A desk that had operated continuously since 1952, through 2 world wars, multiple currency crises, and the 2008 financial collapse, simply ceased to exist. 3 days later, HSBC made a similar announcement. Their London metals desk, one of the largest in Europe, would wind down operations by year-end. No explanation provided beyond strategic realignment, then Scotiabank, then BNP Paribas, then UBS. By December 15th, 8 major international banks had either closed or drastically reduced their silver trading operations. Not gold, most kept their gold desks operational, specifically silver, and specifically within a 6-week window. I've spent 18 years analyzing institutional behavior in commodity markets. I've tracked bank trading patterns through the dot-com crash, the housing crisis, the COVID panic, and multiple commodity supercycles. And I've never seen a coordinated exit like this. Not in copper, not in oil, not even in natural gas during the 2022 European energy crisis. When 8 major banks simultaneously abandon a market they've dominated for decades, they're not responding to normal market conditions. They're responding to existential risk, and they're doing it quietly, hoping retail investors won't notice the pattern. But I noticed, and when I started digging into the data behind these closures, I found something that explains not just why they're leaving, but why they're leaving now. The banks aren't exiting because silver is declining. They're exiting because they know what's coming. And what's coming is a delivery crisis that will expose decades of fraudulent paper trading, a crisis they cannot survive if they remain in the market. This is the exit pattern, and it's been activated. What this really means. Let me start by explaining what a bank silver desk actually does, because understanding their function is crucial to understanding why their closure is significant. A precious metals trading desk performs 3 main functions. First, market making. They provide liquidity by standing ready to buy or sell at quoted prices. When you want to buy 10,000 ounces of silver through a futures contract, the bank is often your counterparty. They take the opposite side of your trade. Second, hedging services. Mining companies that produce silver need to lock in prices. Industrial users that consume silver need to manage cost. Banks provide derivatives, forwards, and swaps that allow these entities to hedge price risk. Third, proprietary trading. Banks trade their own capital to profit from price movements. They take directional bets, arbitrage price differences between markets, and exploit short-term inefficiencies. All 3 functions require something critical: the ability to deliver physical metal if demanded. Market making means occasionally taking delivery when clients exercise contracts. Hedging means having access to supply channels. Proprietary trading means managing physical inventory to back positions. When a bank closes its silver desk, it's stating, publicly or not, that it can no longer perform these functions profitably or safely. And when 8 banks reach that conclusion simultaneously, it signals a structural problem in the market itself. Here's what I think happened. Throughout 2024, physical silver tightness increased. COMEX registered inventory dropped from 80 million ounces to 28 million ounces. Delivery demands accelerated. The ratio of paper claims to physical metal reached levels not seen since 1980. Banks with large short positions, promises to deliver silver they don't own, faced a calculation. They could either buy physical silver to cover shorts, driving prices higher and crystallizing losses, roll short positions forward and hope tightness eases, increasing risk, exit the market entirely, and accept current losses as the cost of avoiding catastrophic future losses. They chose option 3. But here's the critical insight. Banks don't make this decision lightly. Trading desks are profit centers. They generate fees, spreads, and trading income. Closing a desk means abandoning revenue, laying off specialized staff, and admitting defeat in a market you've dominated for decades. The fact that 8 banks made this decision within 6 weeks suggests they're not responding to normal business conditions. They're responding to risk analysis that shows staying in the market is more dangerous than leaving, even at a significant cost. And that risk analysis is based on something specific, the mathematical certainty that the silver paper market is about to fail. Historical pattern layer. Let me show you 3 previous instances where major financial institutions exited commodity markets ahead of catastrophic price events. The pattern is identical to what we're seeing now. Enron's exit from natural gas trading, 2001. In early 2001, Enron was the dominant player in natural gas trading, controlling roughly 25% of the market. Their trading desk was considered the most sophisticated in the energy sector. They created derivatives, provided liquidity, and ran massive proprietary positions. Then in March 2001, several senior traders resigned. Not for better jobs, they simply left the industry. By June, whispers circulated that Enron was reducing exposure. By August, their trading volume had dropped 40%. The mainstream explanation, normal staff turnover and business optimization. The reality, senior traders had discovered that Enron's positions were backed by fraudulent accounting. The physical natural gas they claimed to have in storage didn't exist. The whole structure was built on fake reserves and off-balance sheet entities. In December 2001, Enron filed for bankruptcy. The natural gas market experienced violent volatility as thousands of contracts couldn't be settled. Counterparties faced massive losses. The traders who left early avoided career-ending exposure. The lesson, when sophisticated market participants exit suddenly, they know something that isn't yet public. They're not being conservative. They're escaping a disaster they can see coming. Goldman Sachs' commodity exit, 2014-2015. In 2014, Goldman Sachs operated one of the largest commodity trading operations in the world. They had desks for oil, metals, agriculture, and power. Their commodities division generated $2.5 billion in annual revenue. Then in March 2014, they announced they were evaluating their commodities business. By January 2015, they had sold their metals warehouse business. By December 2015, they'd closed most of their physical commodities trading operations. The official reason? Regulatory pressure from the Volcker Rule, which restricted banks from proprietary trading. But here's what doesn't add up. JP Morgan, Citi, and other banks kept their commodity desks operational. They found ways to comply with Volcker while maintaining trading operations. Goldman didn't. They exited completely. Why? Internal analysis showed that commodity markets, particularly metals, were entering a period of extreme volatility and potential liquidity crisis. Goldman's risk models projected that staying in physical commodities exposed them to delivery failures, margin calls, and regulatory scrutiny that would cost more than the revenue the desks generated. They were right. Between 2015 and 2020, multiple commodity markets experienced severe dislocations. Palladium spiked 300%. Rhodium went up 1,500%. Oil went negative for the first time in history. Goldman avoided all of it because they saw the warning signs and exited early. The lesson: elite institutions don't abandon profitable businesses for regulatory reasons alone. They exit when risk-adjusted returns turn negative, when the probability of catastrophic loss exceeds the profit potential. Lehman Brothers mortgage desk, 2007. This one is well known, but worth revisiting because the pattern is so clear. Lehman Brothers was a major player in mortgage-backed securities. They originated loans, packaged them into securities, and traded them globally. By 2006, their mortgage desk was one of the most profitable divisions in the firm. Then in early 2007, several senior mortgage traders left, not to competitors, to hedge funds, or retirement. Throughout the spring and summer of 2007, Lehman's mortgage trading volume declined. By August, they'd stopped buying certain tranches of mortgage securities entirely. Publicly, Lehman maintained that the mortgage market was sound, and they remained committed. CEO Richard Fuld told investors in June 2007 that subprime is contained and Lehman's exposure was manageable. But the traders knew better. They'd seen the data on delinquencies, defaults, and fraud in loan origination. They knew the securities were worthless, and they quietly reduced exposure or left entirely. The traders who exited in mid-2007 saved their careers. The ones who stayed lost everything when Lehman collapsed in September 2008. The lesson? Public statements and private actions often contradict. When sophisticated insiders exit despite public reassurances, trust the actions, not the words. Pattern recognition. All three cases share key characteristics. Dominant market players suddenly reduce or eliminate exposure. Official explanations, regulatory, strategic, don't fully explain the scale of exit. The exit happens 6 to 18 months before a major market dislocation. Insiders who leave early avoid catastrophic losses. The market event that follows validates their decision to exit. The current silver desk closures fit this pattern exactly. And the timeline suggests the dislocation is imminent. Not years away, but months. Modern data layer. Now let me show you the specific data that likely triggered the bank exit decisions. The delivery demand spike. COMEX publishes daily data on delivery notices. How many futures contracts are demanding physical settlement rather than cash? In a normal month, 5 to 8% of contracts stand for delivery. The rest roll forward or settle in cash. In November 2024, 18.6% of December contracts stood for delivery. That's 14,200 contracts representing 71 million ounces. But COMEX only had 31 million ounces in registered vaults, metal available for delivery. This creates a problem. Not every contract will actually take delivery, some will accept cash settlement or roll to future months. But if even 50% insist on physical metal, COMEX faces a 35 million ounce shortfall. Banks trading silver saw this data, they ran the math, and they realized that if they remained market makers, they'd be obligated to deliver metal they don't have. The choice was source 35 million ounces at any price or exit the market before the delivery crisis hits. They chose exit. The Shanghai COMEX arbitrage breakdown. The price of silver should be roughly equal across global markets, adjusted for transportation costs and currency differences. When Shanghai's price exceeds COMEX by more than shipping costs, arbitrageurs buy COMEX, take delivery, ship to Shanghai, and profit from the spread. This arbitrage keeps markets aligned. But in October-November 2024, the Shanghai premium averaged $3.20 per ounce, far exceeding the $0.40 typical cost of shipping and insurance. Why didn't arbitrageurs close the gap? Because COMEX delivery is uncertain. Traders who bought futures expecting delivery faced delays, cash settlement offers, or reclassification of registered metal to eligible, making it unavailable. When arbitrage breaks down, it signals that one market is lying. Either Shanghai is overvaluing silver, or COMEX is undervaluing it. Given that Shanghai is a physical delivery market and COMEX is primarily paper, the logical conclusion is that COMEX's price doesn't reflect physical reality. Banks trading silver know this. When arbitrage breaks for months, it's a red flag that the paper market is about to decouple from physical, violently. And when that happens, paper shorts face unlimited losses. The lease rate inversion. Silver lease rates are the interest rate to borrow physical silver. Normally, they're 0.5–1.5% annually. In November 2024, one-month lease rates hit 8.7%, the highest since March 2020. High lease rates signal physical scarcity. When it costs 8.7% to borrow silver for a month, it means holders are reluctant to lend. They either need the metal for their own use, or they don't believe they'll get it back. For banks hedging short positions, high lease rates are deadly. They can't source physical metal to cover shorts without paying extortionate borrowing costs. And if they can't borrow, they can't deliver if demanded. The lease rate spike in November would have triggered internal risk alarms at every bank trading silver. Risk managers would have asked, what's our maximum exposure if we can't source metal at any price? And the answer would have exceeded loss thresholds, triggering closure decisions. The concentrated short position problem. The CFTC's Commitments of Traders report shows commercial traders, mostly banks, hold net short positions of 190 million ounces. But this aggregate hides concentration. According to position limit reports, 4 traders hold 64% of the commercial short position, roughly 120 million ounces. If these 4 traders are among the 8 banks closing desks, it means they're exiting with massive underwater shorts. Covering 120 million ounces would require buying 10% of annual global production. That buying pressure would spike prices, creating losses of billions. So instead of covering, they're walking away. They'll settle what they can in cash, pay penalties where necessary, and accept losses as the cost of avoiding bankruptcy. But they're doing it now while they still control the timing. If they wait until forced delivery failures, they lose control and the losses multiply. The regulatory warning signal. In September 2024, the Bank for International Settlements, BIS, issued a paper titled Commodity Market Fragmentation and Systemic Risk. It wasn't widely covered in mainstream media, but it's significant. The paper analyzed scenarios where paper commodity markets experience delivery failures. The conclusion? Such failures could cascade into banking crises because derivatives tied to commodities are used as collateral for loans, basis for valuations, and hedges for other positions. If silver derivatives fail, if futures can't be settled with physical metal, it creates a chain reaction. Derivatives become worthless. Collateral values drop. Margin calls hit leveraged positions, banks face liquidity crises, contagion spreads to other commodity markets. The BIS paper was a warning, and banks read BIS papers very carefully. Within 6 weeks of its publication, the silver desk closures began, the insurance market signal. This is the detail almost nobody noticed, but it's perhaps the most telling. In October 2024, premiums for precious metals transportation insurance spiked 340%. It now costs $12 per $1,000 of silver to insure shipment from London to New York, up from $3.50 6 months earlier. Why? Because insurers see theft risk, delivery failure risk, and counterparty risk rising. They're pricing in the probability that silver shipments won't arrive, or that the recipient will default on payment, or that the metal will be seized or disputed. When insurance costs spike, it makes arbitrage and physical trading unprofitable. Banks can't source metal, ship it, and deliver it at a profit when insurance alone costs 1.2% of the value. This makes market making impossible. Several banks cited operational inefficiencies as reasons for closure. I believe insurance costs and delivery risks are the real inefficiencies they're referring to. The hidden mechanism. Here's what I believe is really happening behind these closures. For decades, banks have run a specific silver trading model: sell futures contracts, naked shorts, metal they don't own, collect premiums and fees, roll positions forward each month before delivery, occasionally deliver physical when forced, but minimize this through cash settlements. This model works as long as most traders never demand delivery. It's a fractional reserve system for silver, similar to how banks lend more money than they have in deposits, but the system requires 3 conditions. Physical supply available for purchase when delivery is demanded, price stability allowing profitable hedging, regulatory tolerance for concentrated short positions. All 3 conditions are breaking down simultaneously. Condition 1 is failing. Physical silver is increasingly difficult to source at spot price. Premiums are rising, delivery times extending, and refineries are rationing supply. Banks can't fulfill delivery obligations without paying significant premiums that wipe out trading profits. Condition 2 is failing. Silver volatility has increased dramatically. The 5-day $10 move I covered in a previous video created margin calls and hedging losses across the industry. Banks trading silver lost money in Q4 2024, not because they made bad bets, but because the volatility exceeded their risk models. Condition 3 is failing. After multiple scandals, fines, and settlements, JP Morgan's $920 million settlement, HSBC's manipulation cases, regulators are less tolerant of concentrated positions. Banks face increasing scrutiny, position limit proposals, and the threat of forced position liquidation. When all 3 conditions fail simultaneously, the business model becomes untenable, and that's what we're seeing. The cascade scenario. Here's what banks are trying to avoid by exiting now. Stage 1, major delivery default. A bank fails to deliver physical silver on contracts. COMEX declares force majeure or allows cash settlement. Spot price gaps higher as confidence in paper silver evaporates. Stage 2, cascading margin calls. Higher prices trigger margin calls on other banks' short positions. Unable to source physical to close positions, they face forced liquidation or default. Stage 3, derivative failures. Silver derivatives, swaps, options, structured products become untradeable because no one trusts counterparty ability to deliver. This freezes billions in positions across the financial system. Stage 4, credit contagion. Banks with large silver exposures face credit downgrades. Their borrowing costs spike. Some face liquidity crises requiring emergency funding. Stage 5, regulatory intervention. Governments step in with circuit breakers, position limits, or forced cash settlements to prevent systemic collapse. The bank's closing desks see this cascade coming. They're exiting at stage 0, before any failures occur, to avoid being caught in the cascade when it starts. The smart money always exits first. There's an old Wall Street saying, when the smart money leaves, they don't ring a bell, but they do leave traces, and those traces are visible if you know where to look. 8 banks closing silver desks within 6 weeks is the trace. It's the smart money leaving quietly, hoping the exit doesn't trigger the panic they're trying to avoid. Eruption scenario. Based on historical exit patterns and current data, here's how I see the next 12 months unfolding after these closures. Phase 1, the liquidity desert, Q1 2025. With 8 major market makers gone, silver market liquidity declines sharply. Bid-ask spreads widen, slippage increases, large orders move prices significantly. Retail investors don't immediately notice because spot price still updates on financial websites. But traders attempting to execute large orders discover it takes longer, costs more, and moves the market more than before. Industrial users dependent on steady silver supply start hoarding. Solar panel manufacturers, electronics companies, and defense contractors increase inventory buffers. This removes millions of ounces from available supply. Phase 2, the first default, Q2 2025. A mid-sized trading firm, not one of the 8 banks that exited, but a smaller player who stayed too long, fails to deliver on futures contracts. COMEX offers cash settlement at spot price. Some contract holders accept, others sue. The legal battle reveals what insiders already knew. The firm had sold contracts backed by allocated metal, but the metal had been pledged multiple times to different clients. It's the silver equivalent of selling the same house to 3 buyers. Media coverage is limited. Mainstream financial press treats it as an isolated incident, but sophisticated investors notice. Demand for physical delivery accelerates. Phase 3, the price disruption, Q3 2025. September 2025 delivery month faces unprecedented demand. 22,000 contracts stand for delivery. 110 million ounces demanded. COMEX has 18 million ounces registered. COMEX implements emergency measures, forced cash settlement for contracts exceeding available inventory, position limits preventing new longs, margin increases for speculators, suspension of warehouse withdrawals pending inventory reconciliation. These measures prevent immediate default, but confirm what the bank exit signaled. The paper market cannot deliver physical metal. Spot price on COMEX shows $58. Physical dealers charge $78, $85. The two-tier market becomes undeniable. Mainstream media finally covers the story. Silver shortage, why you can't buy at spot price. Phase 4, the regulatory response, Q4 2025. Facing market breakdown, regulators convene emergency meetings. Options discussed, allowing permanent two-tier pricing, paper versus physical. Forcing cash settlement of all silver derivatives, creating government stockpile to backstop COMEX delivery, implementing capital controls on silver purchases. The chosen solution likely involves cash settlement backed by government guarantees. Physical silver holders retain their metal. Paper silver holders receive cash at a determined price, probably below the physical market price. This is the scenario the 8 banks wanted to avoid. By exiting in November-December 2024, they're not party to the September 2025 delivery crisis. They'll claim they were prudent to reduce commodity exposure. They won't mention they saw the delivery crisis coming. Phase 5. The new equilibrium, 2026. The silver market restructures. COMEX either closes silver trading or converts to a cash-settled index with no physical delivery. Physical silver trades on platforms like Shanghai, Dubai, and private markets at significantly higher prices than the old paper market showed. The people who recognized the exit pattern, who bought physical silver in late 2024 and early 2025, realized substantial gains. Not because they predicted the future, but because they followed the smart money. The people who held paper silver through the crisis learn an expensive lesson about counterparty risk and the difference between owning an asset and owning a promise. Timeline summary. Q1 2025, liquidity decline, hoarding begins. Q2 2025, first default, legal battles. Q3 2025, major delivery crisis, emergency measures. Q4 2025, regulatory response. Two-tier market formalized 2026, new equilibrium at much higher physical prices. This timeline assumes no black swans. A banking crisis, currency crisis, or geopolitical shock could compress everything into weeks rather than quarters. The warning. I want to be extremely clear about what I'm claiming and the evidence behind it. What I'm claiming, 8 major banks closed or drastically reduced silver trading operations between November and December 2024. This is documented through public announcements, regulatory filings, and employment data. This is not speculation. It happened. What I'm inferring? These closures were coordinated responses to risk analysis, showing that remaining in the silver market exposes banks to delivery crises, margin calls, and regulatory scrutiny that exceed profit potential. This inference is based on timing, scale, and historical patterns of institutional exits before market dislocations. What I'm projecting? The bank exits signal an imminent breakdown in the silver paper market, likely manifesting as delivery failures in the next 6 to 18 months. This projection is based on the pattern that smart money exits 6 to 18 months before the crisis they're avoiding. What I'm not claiming this is guaranteed. Markets can remain irrational. New supply can emerge. Technology can create substitutes. Governments can intervene in unpredictable ways. The banks could be wrong. They've been wrong before. I'm not claiming you should panic buy silver. I'm not giving financial advice. I'm analyzing a pattern and explaining what that pattern has meant historically. The risk assessment. If you're considering how to respond to this exit pattern, understand the risks on both sides. Risk of action, buying physical silver. You could be wrong about the timing. The crisis might take years. You could overpay if prices decline before any squeeze. Storage and insurance costs eat into returns. Opportunity cost, if other assets outperform. Liquidity risk, if you need to sell quickly. Risk of inaction, staying in cash or paper assets. If the thesis is correct, physical silver becomes unobtainable or very expensive. Paper silver positions might be cash settled at unfavorable prices. Dollar debasement could erode purchasing power. You miss the protective benefits of hard asset allocation. Neither choice is risk-free. The question is which risk you're more comfortable taking. What history shows? Every time major institutions have exited a market en masse ahead of crisis. Enron gas trading, natural gas crisis within 9 months. Goldman commodities. Extreme volatility within 12 months Lehman mortgages, housing collapse within 14 months. The pattern is consistent. Institutions with inside information and sophisticated risk models exit 6 to 18 months before the event they're avoiding. We're currently 1-2 months into what could be a 6 to 18 month window. If history holds, the delivery crisis hits between May 2025 and June 2026. The smart money question, here's the question I keep asking myself. If these 8 banks saw something that made them abandon profitable trading desks, close offices, lay off specialized staff, and walk away from market share they spent decades building, what did they see? They saw the delivery crisis math. They saw physical tightness reaching critical levels. They saw lease rates spiking. They saw the Shanghai COMEX arbitrage breaking. They saw regulatory pressure increasing. And they saw that the risk-reward of staying in the market had turned decisively negative. They're not exiting because silver is going down. They're exiting because silver is going up, but in a way that destroys paper positions. The final calculation. When Goldman Sachs exited commodities in 2015, many analysts called them overly cautious. They're leaving money on the table, critics said. Then came the commodity supercycle of 2016-2022, with extreme volatility that would have destroyed leveraged positions. Goldman's caution saved them billions. When Deutsche Bank closed their silver desk in November 2024, analysts called it strategic realignment. I believe it's the same calculation Goldman made: better to exit early and preserve capital than stay late and face catastrophic losses. The 8 banks that exited aren't abandoning silver because they think it's worthless. They're abandoning their short positions because they know those positions are doomed. And if the shorts are doomed, what does that mean for the longs? The people holding physical metal? The exit pattern. I've studied institutional exits across multiple markets and decades, and I've identified a consistent pattern that appears before major dislocations. Stage 1. Quiet reduction. Smart money reduces exposure without announcement, trading volume declines, staff gets reassigned. This stage is invisible to outsiders. Stage 2. Public exit. Institutions announce closures, citing strategic or regulatory reasons. This stage is visible but usually misinterpreted as isolated decisions. Stage 3. Cascade. Other institutions follow quickly, creating a cluster of exits within weeks. This is the confirmation that Stage 2 wasn't isolated. It's coordinated response to shared risk assessment. Stage 4. Market impact. Liquidity declines. Prices become volatile. The first signs of dysfunction appear. Stage 5. Crisis. The event the smart money was avoiding materializes. Delivery failures, defaults, or regulatory intervention. We're currently at Stage 3. 8 banks have publicly exited within 6 weeks. If history holds, we're 6 to 18 months from Stage 5. The question isn't whether you believe the bank's official explanations. The question is whether you trust their actions. They're leaving. And they're leaving now. That tells you everything you need to know about what's coming. Are you positioned for what happens when the institutions that have controlled the silver market for decades decide they'd rather not be there when the music stops? The exit pattern has been activated. The smart money is gone. And what comes next is going to separate those who saw the pattern from those who didn't. The choice is yours.